Someone is ready to purchase a house.
Okay.
What are their first steps? What do they do?
Number one is pre-approval.
Okay.
So that means that they come to someone like me and we look at their credit, their income slash debt ratios, and also their assets to see if they have money to put down.
Hmm.
When I'm excuse me, when I'm talking about debt ratios, that's something that people don't understand. So I'm just going to explain that just briefly.
Okay.
Debt ratio is the amount of debt that you have divided into your gross monthly income. Okay.
Okay.
So we take all your credit cards, your car payments, your student loans, then we add a house onto that, and then we divide it into your gross monthly income.
Okay.
That's how we come up with a debt ratio.
Yep.
So basically, we're trying to determine what we think you can afford.
That's a difference too, which we'll talk about later. What
Yes.
the bank thinks you can afford versus what is smart for you
Yes.
to afford.
Correct.
Hmm.
And so that's what we're trying to come up with. Can they afford it? Does their credit say that they are a trustworthy person? Something else people don't know about. That's basically what a credit report is. It's basically us getting a report from somebody to say how likely is this guy to pay me back, right?
Hmm.
Credit scores right now go from 350 to 850, right? So if you have a 700 credit score, basically we think there's a 70% chance you'll pay us back.
That
Think
math doesn't really work out, but
no, I mean
I
that's
mean, if it's
that's
850, if 850 is the highest.
no, but I said 700
Oh,
credit
okay,
score.
gotcha, gotcha. Okay.
700 credit score
Hmm.
means there's a 70% chance. 850 is the highest. Why? I always thought that. Why is 850 the highest? Because that 15% allows for time and unforeseen occurrences. Because that can happen to anybody. You could want to pay your bills, but you could lose your job and not be able to.
That's the gap between. Okay, so that's so okay.
Right.
That's why I was
So
thinking
there's a
that.
15%
I
variance
did not know
for
that.
any
Sorry about
person.
that.
Yeah.
Interesting.
So here you are. At most you're 85% likely to pay us back.
Hmm.
At best, right?
Hmm.
But as your score goes down, that's why when you start to get into the 500s, you get less people trying to do loans for you because, this is a 50-50 chance of me getting my money back.
Hmm.
And if you're lending your own money,
Nope.
I didn't even get to finish the question. That's what I'm saying though. But yeah, that's exactly it. You want somebody to get your money that's going to pay it back. That's basically all that banks and mortgage companies are doing. We're
Mhm.
we are trying to prove that you can pay us back.
So what boxes are you checking when you're looking at that? So obviously you're looking at credit score. That's
Yep.
one box. What
Yep.
else?
The income,
Income. Okay.
income, and then the other thing is your assets. Okay.
Hmm.
So and when I say assets, like a young person might not have a lot of cash and stuff built up at that point, right? But basically, what I can see by looking in your bank account, are you saving your money? I've had people that by the time that they pay their rent and all their expenses, there's $100 left at the end of the month. That's a problem. Now, I will tell you that a closer look at that bank statement usually means that like they're going to Vegas every couple of weeks or on vacation all the time with their
Hmm.
friends, living their best social media life or whatever. Because some of these people
For the
like make
gram.
really good money and just like only have $100 left at the end of the month. It's like something's not adding up.
Right.
We need to call your parents.
Right. Okay. Then what?
So after we figure all that out, we come up with a number, and it's like, all right, this is the number that you can afford as far as your house. So now it's about what type of loan that we're gonna do.
Okay.
Now there's several different types of loans, but the majority of people do either a conventional loan or an FHA loan.
Hmm.
That's the majority of people.
Difference. So because that's something I hear a lot. I
Yes.
hear a lot. A lot of people are scared of FHA because they
Hmm.
can afford a conventional, or vice versa. Other people are trying to go the investment route, so they are FHA minded. Can you kind of create the difference for us?
So
And also, if you don't mind, can you also go into why, like, so the general, here's the difference between the two, and then
mhm.
why, which situation each person would want to use one.
Well, generally, an FHA loan historically has required a lower down payment.
Okay.
That's number one. They also allow lower credit scores.
Okay.
Okay,
Hmm.
and it is federally backed by the government. So the government just straight makes all the rules on it. They insure it. and it's a good product for most people. A lot of them also come with like first time home buyer programs. So if you haven't had a chance to save a lot of money, a lot of times you can get special programs so that you can get your down payment paid
Yep.
if you qualify for it. So FHA in itself is a good product. I have nothing against FHA. I think it actually gets a bad rap. A lot of people that are using that loan are not necessarily what people think in their mind. They think in their mind that like FHA people are like lower class,
Hmm.
like, oh man, these are just people with lower credit scores who haven't done a good job taking care of their life situation, yada, yada. It's not. A lot of people are just coming out of school, they haven't had a chance to build a lot of credit, and, they have a good job now, and they just, I've only been making money for a year. I haven't had a chance to save $20,000.
Hmm.
So a lot of those are the people that I see doing FHA loans
Okay.
these days.
So
So
if you were to cycle that into conventional.
so conventional is basically you have a decent sized down payment. Now, majority of people who do conventional loans now can do them with as little as 5% down. The
Okay.
majority of people who
Yep.
do
For your
conventional
primary.
loans right now do them with as little as 5% down.
Hmm.
Okay. But there are some situations, like if you're lower income, like sometimes you'll be able to do it with 3%.
Mm.
But most of the time it's 5% down.
You didn't tell me about the 3%, man.
Well, the type of property that you buy also factors
Yep,
in.
that's true.
Okay.
That's true.
So it's
I'm buying a lot of investment properties, guys. Yep.
right,
So yep.
right. So it's not like you can just do it on anything, and you can't do it on multifamilies.
Hmm. Hmm.
Um, so that's the main thing. Then usually you have to have a higher credit score, like kind of a base that we look at is like 700 or above,
Okay.
right? So if you're a 700 above credit score, we're usually looking at you for conventional first, right? And then conventional, the loan is just a bit cheaper, a little bit. As time has gone on, they've kind of started to even out. But the conventional loan is a little bit cheaper. There's a little bit less that goes into the inspection by the appraiser
Hmm.
when they go out to see the house. And but to be honest with you, I feel like conventional and FHA loans, as they've adjusted over time, are very similar now.
Hmm.
FHA is actually in some situations just a better financial tool. I have some people who have 700 credit scores that, just because of their situation choose to do an FHA loan.
Yeah. So it really comes down to that conversation that you have with
Yes.
your mortgage banker.
Yes.
That's what matters.
Yes.
And that also takes me into the conversation of who you choose to be your mortgage banker and your realtor. You want to work with someone that's within your personal network. So I would even go back to what you said, like the first step would be.
Hmm.
I would even go back to change that to I think the first step should be reaching out to your personal network. Reaching out to someone that you know that just bought a home, or if you have a realtor that's in your personal network or a mortgage banker that's in your personal network, reach out to them first. And then once you do that, work with, so for example, you want to buy a house, instead of going online and calling the realtor that's on the listing online, instead of doing that, reach out to someone in your network, go start looking at houses, and then work with the mortgage banker that they recommend. Because I mean, this is the biggest purchase of your life, right? So you want everything to work like a fine-tuned machine. But I do see that a lot. A lot of people would just like go on the listing and then they'll call the listing agent that's on the listing.
Yeah.
And one thing you need to know is that they do not work for you, right?
Yeah.
That is not their first obligation. So some food for thought there too.
Yeah, there's a listing agent and then there's a buying agent.
Hmm.
The listing agent works for the seller.
Correct.
They're trying to get them the most money and the best